A full-time CFO will cost you $250,000 to $350,000 a year in salary and benefits. A fractional CFO will cost a third to maybe half that. And here's the part that nobody talks about fractional CFOs. They often can deliver the same, if not better results than having someone in-house. Look, if you're running a business doing $2 to $20 million in revenue this year, you're in this weird middle zone. You're too big to wing it with just a bookkeeper, but you're too small to afford a full-time CFO with that level of expertise. So what typically happens to business owners in this situation? Well, they make financial decisions based on their gut or outdated reports or advice from their accountant that's really only focused on compliance, not strategy. According to multiple industry analyses, full-time CFOs in the US typically earn $250,000 to $350,000 a year, including salary, benefits, and equity, whereas fractional CFOs are around $60,000 to $180,000. That's a 50 to 75% reduction in cost while still delivering similar results. But here's what's wild. I've seen many companies hire fractional CFOs, including ourselves, and boost profit margins, revenue growth, and overall cash flow in a short period of time while giving them a lot more flexibility and visibility into their business. By the end of this video, you're going to know exactly when your business needs a fractional CFO, what they actually do that your bookkeeper and accountant don't, and the 5 things that great fractional CFOs should deliver in the first 90 days. If you want strategic insights like this every week that actually move your business forward, hit subscribe. Every week, we're sharing tips and tricks and videos for business owners and high net worth individuals to improve their business outcomes and their overall financial health. Here's the thing. Most business owners have no idea what a fractional CFO actually does. They just think it's fancy bookkeeping or expensive advice. It's not. And in just about a minute, I'm going to show you exactly what the difference is. But first, let me tell you about a big misconception that's keeping business owners broke. Here's a scenario I see all the time. You're a business owner doing $5 million in revenue. You're profitable, at least on paper. You have a bookkeeper who closes your books every month, an accountant who does your taxes. Seems like everything's perfect, right? But you look at your financials once a month, maybe. You see some numbers on the bottom line, and then what? You make a decision? But here are the questions you can't answer. Can you afford to hire 3 more people right now without running out of cash in 4 months? Which of your products or services is actually the most profitable when you factor in the real costs? If a big opportunity came up tomorrow, a major contract, an acquisition, a strategic hire, could you model out whether it makes sense? And what's your cash runway if revenue drops 20% for 2 quarters? Most business owners can't answer these questions, not because they're not smart, because they don't have the time or the expertise. And their bookkeeper, they're not trained for this. Their accountant, they're focused on tax compliance, not forward-looking strategy. This is the gap that a fractional CFO fills. Let's say hypothetically you're doing $8 million in revenue, growing fast, feeling like you're always scrambling. You think you're doing fine because you're profitable. What if you discovered you were funding $400,000 in unnecessary working capital because your cash conversion cycle was a disaster? Imagine having the support of a fractional CFO to help you restructure your payment terms with your customers and your suppliers. Within a short period, you could free up $300,000 in cash, money that was already yours just trapped in the business. That's the difference between bookkeeping and strategy. And hold on, because a little bit later, I'm going to show you a real-world example of how this plays out. And the numbers are probably going to shock you. So what does the CFO actually do? Let's clear this up once and for all because there's a lot of confusion. Your bookkeeper records transactions. They categorize expenses, reconcile accounts, make sure your books are accurate. That's critical, but it's historical. They're telling you what happened last month. Your accountant or CPA prepares your taxes, ensures compliance, maybe gives you some tax planning advice, which is also critical, but they're primarily looking backwards as well to make sure you don't get in trouble with the IRS. Your fractional CFO, they're looking forward. They're asking, where are you going and how do we get there profitably? Here's what a good fractional CFO actually does. First, cash flow forecasting and management. They'll build a 12-month rolling cash flow model so you know exactly when your cash will be tight and when you'll have a surplus. No more surprises. Second, strategic financial planning. They'll help you model decisions before you make them. Should you expand, hire, invest in that new equipment? They run the numbers to make sure you're making data-driven decisions, not guesses. Third, profitability analysis. They'll break down your business by product, service, customer, and tell you where you're actually making money and where you're just spinning your wheels. Next, fundraising support and investor relations. If you're raising capital or working with a bank, a fractional CFO can help prepare your financials, build a pitch deck, and speak the language of investors and banks. Next, team and board reporting. They'll create KPI dashboards and financial reports that actually help you run the business, not just satisfy the IRS. Your bookkeeper can't do this. Your accountant won't do this. This is C-level strategic work, and that's why it's so valuable. And here's the controversial part that accountants hate when I say. If your accountant tells you that you don't need a fractional CFO because we all handle that, they're either lying or they don't understand the difference between compliance and strategy. Okay, so here's the question everyone asks. At what revenue should I hire a fractional CFO? The traditional answer is $2 to $10 million in revenue, but honestly, that's too simplistic. It's really not about revenue. It's about complexity of your business and your growth goals. Here are some signals for you to track to determine when you need a fractional CFO. First, you're growing fast and cash is getting unpredictable. You're landing bigger contracts, hiring more people, but you're constantly worried about whether you'll have enough cash to make payroll or pay vendors. That's a CFO problem, not a bookkeeping problem. Signal number 2, you're making major decisions based on gut feel alone. Should you expand into a new market, acquire a competitor, launch a new product line? If you're making 6-figure decisions without detailed financial modeling, you probably could use a CFO. Number 3, you're planning to raise capital. If you're about to talk to investors or banks, you need clean financials, projections, and someone who can speak their language. A fractional CFO can pay for themselves in the first negotiation by helping you secure better terms, or just by setting the stage. Signal number 4, your margins are shrinking as you grow. Now this is a big one. You're doing more in revenue, but you feel like you're making less money. That means your unit economics are broken and you need someone to diagnose and fix it. Signal number 5 is that you can't answer basic questions about your business. For example, what's your gross margin by product? What's your cash conversion cycle? What's your customer acquisition cost versus lifetime value? If you don't know these answers, you're flying blind. For most businesses, the sweet spot to bring in a fractional CFO is when you hit $2 to $5 million in revenue and you're planning to scale aggressively. But before you make that hire, you should understand the ROI. Here's what's insane. The fractional CFO industry grew 20% in 2024. Why? Because the ROI is undeniable. Let me give you some real numbers from published case studies. Healthcare startups have doubled monthly revenue after working with fractional CFOs. Manufacturing companies have boosted profit margins by 20% within months. Multiple documented cases show companies improving cash flow by 30% within 6 months. Let's do the math on that last one. If you're a $5 million business with typical working capital tied up, improving cash flow by 30% could free up $200,000 to $400,000. You're paying your fractional CFO maybe $120,000 a year. That's a 2 to 3x return, and that's just one benefit. But here's what nobody talks about: the hidden costs of not having a CFO. And this is the mistake I see business owners make over and over again. Let me show you exactly what that looks like. Here's a picture of one of the most common scenarios we've seen in businesses doing $5 to $50 million in revenue. Imagine you're doing $7 million in revenue, profitable, growing, but you're constantly stressed about cash flow. Some months feel great, others feel like you're scrambling. You bring in a fractional CFO. What's the first thing they do? They analyze the cash conversion cycle. And here's what they typically find. The business is giving net 60 payment terms because that's what the big customers demand, but they're paying suppliers on net 15 because we want to maintain good relationships. That means you're funding 45 days of working capital, potentially hundreds of thousands of dollars out of pocket. A fractional CFO could help you renegotiate these terms. For example, move key customers to net 45 with a 2% discount for net 30, negotiate net 30 terms with top suppliers, implement a collections process for overdue invoices. And what does this result in? Freeing up hundreds of $1,000s in cash within a short period. No new sales, no cost cutting, just better financial operations. If the fractional CFO's fee for that quarter is $30,000, that's potentially a 9x return in 90 days. And here's the thing. You could probably do this for yourself if you knew what to look for, because you're busy running the business and the financial operations aren't your superpower. And that's why you hire expertise, not to do things that you can't do, to do things you don't have the time to, but at a high class level. Now I'm going to show you exactly what to look for when hiring a fractional CFO. But first, and this is critical, you need to understand the 3 engagement models and which one will save you the most money. Here's what to look for. First, industry-specific expertise. For example, if you're in manufacturing, don't hire someone whose only expertise is in software. The business models are completely different. Also, check for a track record of results. Ask for case studies. What companies have they worked with? What results did they drive? If they can't articulate specific outcomes, you should probably move on. Next, strategic thinking, not just technical skills. Anybody can build a spreadsheet. You need someone who can look at your business and identify the leverage points, the places where small changes create big results. Next, communication skills. Your fractional CFO needs to translate complex financial concepts into language you can actually understand and act on. If they talk in jargon and make you feel dumb, they're not the right fit. You want someone who's going to flag issues before they become crises, not someone who only responds when you ask a question. Now, here's where most people mess up. They don't understand the pricing models and end up paying for bad service. Let me break down exactly what you should expect to pay. Fractional CFOs typically work in one of three models. Hourly, which can range from $200 to $700 an hour, depending on the level and the expertise of the person you're hiring. This structure is typically good for non-recurring work like a special project, a fundraising, or mergers and acquisitions. You have a project base, which is a fixed fee for a specific service. You define a specific project and you get a fixed price from a fractional CFO to deliver that outcome. And lastly, the monthly retainer, around $5,000 to $15,000 a month, depending on the scope. This is the most common for ongoing strategic support to help you get you where you're going and continue to scale. For most small businesses in the $2 to $20 million of revenue range, a monthly retainer is typically the sweet spot. That's about $8,000 to $15,000 a month. This is still way less than a full-time CFO, and you get access to someone who's probably more experienced than who you could hire full-time at your stage. But before you reach out to anyone, you need to complete these 5 steps, because if you skip step 3, you're gonna waste thousands of dollars. All right, here's exactly what to do if you're thinking about bringing on a fractional CFO. First, assess where you are right now. Can you answer these 5 questions confidently? What's your cash runway if revenue drops 25 to 30%? What's your gross margin by product or service? What's your customer acquisition cost versus your lifetime value? What will cash flow look like 6 months or 7 months from now? If you wanted to raise capital tomorrow, is your financial data investor ready? If you can't answer at least 3 of these, you probably need help. Next, define what you need. Are you looking for ongoing strategic partnership, or do you have a specific project like fundraising or financial cleanup? Then you should interview at least 3 candidates and ask them, what companies have you worked with in my industry? What results have you driven? Ask for specifics, not generalities. What would your first 90 days look like if we hired you? What tools and systems do you use? Step 4 is starting with a shorter engagement. Don't commit to hiring them for a full year up front. Maybe you want to hire them for a quarter and define clear deliverables and see if it's a good fit. A good fractional CFO will be confident enough to work on that basis because they know they'll deliver results. Step 5 is you should expect results in that first 90 days. A great fractional CFO should deliver tangible value quickly, whether it's a cash flow forecast, a profitability analysis, or fixing broken financial processes. Now, before I wrap this up, I need to tell you about a big mistake I've seen business owners make over and over again with fractional CFOs, because this mistake can literally cause a lot of problems in your business. Let me tell you about a scenario that I once heard about, and it's one of those cautionary tales that keeps business owners up at night. Picture this. A business doing $3 million in revenue with a small team, it's been bootstrapped, it's profitable. The owner's proud they built something from nothing. Then they land their biggest contract ever, $500,000 over 6 months. They're ecstatic. Fast forward 3 months in, and they almost can't make payroll. What happened? The contract had terrible payment terms, net 90 after delivery milestones. But in order to hit those milestones, the company had to hire contractors, buy materials, and invest heavily up front. They were profitable on paper, but completely cash broke. Classic cash flow crisis. In this situation, a fractional CFO could come in and do 4 critical things in 72 hours. First, they'd build an emergency cash flow model showing exactly when you run out of money. Next, they'd probably help you negotiate a progress payment structure with the client, which is a shift from backloaded payments to monthly draws. It'd also help you restructure supplier terms to extend payables by 15 days or so. Lastly, they'd help you set up a line of credit to backstop you in case you need it. The lesson here is important. Revenue doesn't pay bills, cash does. If you don't have someone modeling out the cash flow implications of a major contract before you sign them, you could win yourself right out of business. A fractional CFO engagement might cost $15,000 to $20,000, but it could save your entire business if you have the right person on the team. What's that ROI? All right, let's bring it home. A full-time CFO can cost $200,000 to $500,000 a year, where a fractional CFO will cost a quarter to half of that for the same strategic expertise and often better results because they've seen more businesses and more situations. You need one when you're growing fast and making major decisions, preparing to raise capital, or when you're profitable but constantly stressed about cash flow. The right fractional CFO will deliver tangible value in the first 90 days, whether it's building a model, freeing up trapped cash, fixing broken unit economics, or building better infrastructure that you need to scale. Here's your one action for the next 48 hours. Go through those 5 questions I gave you earlier, Write down your honest answers. If you can't answer at least 3 of them confidently, it's probably time to have a conversation with a fractional CFO. At Proseer, we offer fractional CFO services, and we work with dozens of businesses in the $2 to $20 million range. If you want to talk about whether it makes sense for your business, the link is in the description. No pressure, no sales pitch, just an honest conversation about where you are and what you need. Now, if you want to take this further, make sure you subscribe to our channel and watch other videos where we break down financial KPIs that every business owner should be tracking. Remember, the difference between a business that scales profitably and a business that just spins its wheels is financial leadership. You don't have to do it alone.